Thank you everyone for joining on this Saturday morning. Before starting the webinar, just a quick disclaimer that whatever the stock ideas or sectors that we'll be discussing, it's just for the educational purpose and do your own research before investing on those ideas and themes. Starting with the webinar, I'll be discussing about I'll be discussing about what has happened in the previous year, and I'll be also discussing about the valuation concern on the small and mid cap side. And then my colleague Vijay will also discuss about a few key themes that we are bullish about. And then we also have an important announcement to make at the end of the webinar. So just to start, to have a look back at what has happened in the previous year, right? So the last year started after 18 months of consolidation and correction in the market. And there were concerns on the earnings growth side, there were concerns on the valuation side, but we identified the mispricing in the market. And actually last year also we took a tactical call on the small and mid caps, and we have come up with a new scheme, super value aggressive, where we felt that the small caps are quietly beaten down. And we have launched a scheme. We closed the scheme for subscription in just 4 or 5 months. And today, if you look at the 1 year return is more than around 55, 56% in the scheme. So we took a call last year. This year again we have taken a call on the market, and since we are entering into a very important phase for the economy, so we are taking a 4 or 5 year call, and basis that we'll also be discussing about it at the end of the webinar. But before that, just to understand the construct of the market currently. So if we look at for any rally to sustain, so we have seen 1 year of good gains from the market, but going forward, this rally to sustain, there are three or four key important things. The first is the macros, how the macros shape up. The second is the earnings. The third is the valuation, and the fourth is the sentiment. So if we have to dissect the macros today, the last 1 year has been very good for the market. It's a very stable year after a volatile FY23. So today, if you look at the concern that comes from mainly from the outside, which is the fluctuation, the crude prices or the global inflation. So fortunately, both were very stable in the FY24 year, and going forward also we feel that the things will remain stable. On the domestic macro side, so if you look at the numbers, the consumption of high ticket size items, maybe it's the real estates or high ticket size automobile items or the consumer spending. So it has been very buoyant, supported by high credit growth into the market. So overall, we see that the macros have been stable, and going forward also there is a trend that the things will remain stable, at least for the domestic market. Now coming to the earnings front, so what we have witnessed last year in the first 9 months, the earnings for the BSE 500 universe expanded by 18%. So this is the most point earning that we have seen in the last decade. If we remove the outlier effect that we have seen during COVID and the base effect and the spike in the earnings because of the base effect. But the things are remain quite favorable on the earnings side. I'll discuss more about the earnings in the subsequent slides. But third, we on the valuation front, if you look at, so the last rally, the rally that we have seen in the last year, so actually it has put the valuations ahead of the earnings if you look at a very short term. But if we just broaden the horizon and look at how the earnings has come up in the last 4 or 5 years, so the things remain favorable there as well. And lastly, on the sentiment side, so the last year we have seen the participation. Probably we can go to the previous slide, please. So last year, what we have seen that the retail participation in the market has increased. In fact, if you look at the last year average, every month we have seen 30 lakh demat accounts being opened, right? So it means that the retail is also now participating in the market, and we are saving 25% of our of our investment. So mainly those savings are also coming back to the market now, and are finding a way to come to the market through the increased retail participation. So those four factors bearing the valuation one remain favorable, and I'll discuss the concerns on the valuation also in the subsequent slides. But let's just understand what has happened in the last year in terms of where we have made the money. So if we can move to the next slide, please, Prabhu. So FY24 was a year, it was neither of quality nor of growth. And what I mean by quality is that companies which can compound the cash flows, or can maintain a ROA and ROC level of more than 18% for a very long period of time, and have a very long and stable earnings trajectory in place, right? And the promoters are also minority investor friendly, and these are clean corporate governance run businesses. So if you look at the returns being contributed, the quality and the growth companies, that was very narrow. In fact, in a high rate environment, the terminal value of the growth oriented companies goes down substantially. So that's exactly we have seen in the last year. We have seen the quality and growth to underperform the non-quality side of it, right? So what we have seen, the low PE companies going and expanding the multiple by 4x or 5x. In fact, the last 1 year return of neither quality nor growth companies were 59% on an average for the BSE 500 universe, while it's just 26 and 33% for the quality and growth companies. If you compare that to the 10-year average, so there the quality and growth companies clearly outperform, right? So we expect that things to again go back to the things to revert to the mean in the long term, and we expect that we have seen the one time repricing of the valuation of the low P companies, and going forward the companies which will be delivering earnings, the company which are more quality oriented, have better allocation towards the capital allocation policy in place, so those companies will dominate the markets going forward. So if you can just move to the next slide, Prabhu, please. Yeah. So now there are concerns like, very recently we have seen a correction in the market, and we have seen the small cap index plummeted by 12%, mid cap by 9-10%. So there were concerns that whether the small cap rally is over now and should we reallocate the investment to the large cap completely. So as on date, we remain very bullish on the small cap side. Obviously, the most of the gains that were there to make in the market were made in the first year. Going forward, there could be in the midterm or in very near term, there could be some bit of volatility into the small caps. But if you look at the entire cycle, we remain very constructive on it, right? So the reason behind, if you look at the last 20 years of data, so the average time for a cycle to peak is roughly between 18 months to 24 months. And we have seen the cycle to peak also, it take times to at least 30 months also to peak out. So and if you look at the current rally is roughly around 1.6x, and normally the market expands by 2x to 3x. So we are at very early stage of the cycle, and there is more room for the small caps and the mid caps to grow going forward. Now let's talk about the valuations. Prabhu, just move to the next slide, please. Yes. So before that, let's just understand what has changed in the small and mid caps. And we are discussing about the small caps here, but the same applies to the mid caps as well. So before COVID, the small cap companies were not well run, and that was evident from the free cash flow that these companies were generating. So between FY17 to 20, the free cash flow that's generated by the small cap companies were negative 16%. But the COVID forced the companies to be more efficient, more productive on the margin front, and to allocate better into the new ventures. So if you look at the free cash flow CAGR that has come up post COVID, it's roughly around 50%. And if you also look at the debt to equity level, so in the past decade we have seen the companies to getting to fall under the burden of interest coverage and all. But if you look at the interest net to equity level, net debt to equity level from FY17 to 24, so we have seen those numbers to come down significantly from 1.7x to 0.2x currently, right? And that's the reason why even at the all-time high, the decadal high interest rates that we are seeing, these companies are not facing the brunt of it because the debt level has been kept at the minimal level that's expected from them. And also, if we can see on the revenue growth side, so the revenue growth has clearly outpaced the capex growth. It means the companies have grown at a CAGR of 16%, but they have not reinvested those proceeds, the excess balance on the excess surplus on the balance sheet into the business. And these companies are cautious. They are also waiting on the sidelines when we engage with the management. So we also get a view that most of these companies are just waiting for the election to get over, and then they will also do the private spending and the private capex. So that's why we are very constructive that the construct of the small and mid caps has completely changed post COVID, and there are merits to value the small caps at the same range as the large caps now. Prabhu, if you can move to the next slide, please. So let's also talk about the EPS growth that has happened in the past, right? So obviously in the 2 year time frame, the share price has rallied ahead of the EPS growth, and there is a bit of margin expansion that also we have seen in both the mid caps and the small caps. But if you can focus on the 5 year side, how the earnings have grown in the 5 years, so clearly the earnings growth has outpaced the share price growth in both the mid caps and the small cap side. It means that whatever the concerns are there on the valuation side, So when we are in an economy where the macros are stable, the valuations are kind of in range bound to the long-term averages. So there is a possibility that the valuation can expand from here further on. And currently, we also have a trigger of rate cut. And again, the election is going to get over. Possibly there are maybe more announcement that will be coming post elections that will be conducive to the a lot of small and mid cap companies which are operating in that range. So there is a very fair case of that expand multiple to also expand. But even though the multiple doesn't expand, that's our best case. Even in the base case, the multiple doesn't expand. The earnings are there to support the price. In fact, on the forward earnings side, if you look at the large caps, mid caps, and small caps, the most of the earnings momentum today is there in the mid and small caps. And if we compare the ROE numbers, so the numbers are almost comparable both for the mid caps and the small caps. The ROE numbers are comparable to the large caps. What it and if we just look at the 5 or 6 year data, 5 or 6 years back data, so the ROE for the small cap companies were just in the range of 12 to 13%. But because the companies have become efficient now, so now they are commanding the same ROE as the large cap companies. And also there is a case that these companies should command the same valuation as the large caps going forward. So Prabhu, now if we can move to the next slide. There is also important, like, the money flow also plays a very important role in sustaining the valuations. So last year has been a good in terms of, like, we have seen the equal participation coming from the FII side as well as the domestic investors, mainly the DIIs. And we have seen this SIP book growing to $2 billion currently per month. And also we have seen roughly 2 lakhs or, like, $22 billion inflows coming from the Indian market from the foreign investor side. And this was just on the anticipation that there could be a rate cut going forward. So actually, when there is a rate cut, there will be a pressure on the dollar, and then the flows will coming to the emerging market side. And obviously, the India will be beneficiary being a part of the EM economy to get some bit of flow. But if we compare the growth that a large side country like India has, and if we compare that to globally, like, what other countries are doing, so no other country comes closer to that. India has a very robust, twin engine where, like, we are able to produce goods at a very competitive price, and then again we have a wide consumer base which can, like, consume those goods. So it's a very self-sustaining kind of economy that we are currently getting into, and like, naturally the foreign investors who are chasing growth should come. Now again, like, a few of the investors have raised the question that maybe because of the high valuation the foreign investors will not come back to the Indian market. But that's not the case, since it's a democracy and it's a country which is open to the policies, right? And, like, which gives easy exit to the FI investors as well. So that makes more and more case for more FIIs and FDIs to come back to the Indian market. So for very recently, we have seen uh, the there's a company based out of UK, BAT, which has sold a stake in the subsidiary company here, ITC, and has taken the proceeds to sort out the balance sheet problems of the parent company, right? So if we are giving easy exit to such multinational players, that's prompt other companies also to come back and invest in Indian market. So all those are structural things. The things will not reverse in single year, but we are hopeful that going forward also, since the elections phase will get over, the rate cut situation will kick into place. So we'll see these events to exemplify a bit going forward in the future. Now, going forward, Prabhu, if you can just move to the next slide, please. So again, there is a reason why we are bullish on the small and mid caps, because it's a very structural thing that's happening to the economy. So if you look at the $1 trillion that we have added in the past, so we took at 60 years to add the first $1 trillion, 7 years to add the second $1 trillion, 5 years to add the $3 trillion. Now we have reached such a size, such a scale that every 6 to 7 years we'll be doubling the economy. So currently today, from, let's say, $4 trillion economy, 3.6 in the formal side, and let's say 600, $700 billion on the informal side. From a $4 trillion economy, if we become a $7 trillion economy by end of 2030, so we'll be adding roughly 400 to $500 billion of GDP every year. Now that's a very huge scale and size for a smaller company which has a market addressable market itself of 20-30,000 crore, and there are more and more sectors like this is coming up, right? So we are also constantly onto the lookout for such sectors which are very small in nature, which have a low addressable market, but these companies are leader in their own market and segments and command, 50-60% kind of share. and these companies are well run by competent management. So for example, we are holding a jewelry company in the portfolio, which is like, operating in north, the northeast part and the eastern India part. And we have the visibility that this company can continue to grow at, let's say, 25-30% CAGR over the entire decade. Or let's say we are holding a retail company, which is exclusively operating in the Bimaru states, but because it's a leader in that segment and understand the geography of that, the consumer sentiment of that specific geography, so the company continues to expand in a very robust manner. So these are some of the opportunities which are out there, and as and when the country grows, the small and mid cap companies or the smaller companies in that geography in that country stands to benefit the most out of it. So just to conclude this section of it, there are few key themes we are really bullish about. So we can just move to the next slide. So if you look at currently, we have sizable exposure into something like manufacturing, financials, building materials, and we have, like, the data also supports that last 1 year the growth in the real estate segment is close to 20%. The government spending is about 10 lakh crore. So naturally, building material is one of the segments that's going to get benefited out of it. Then government incentive schemes on the PLS side, and then there are other schemes on the EV side, plus entire thrust and reduction of tax rate to 15% from the newly incumbent companies makes our manufacturing very competent. Now we are entering into a rate cut scenario, and the access to the easy, low cost capital will also make the financials to come back into the picture, and that can stand to get benefit out of it. Now the other themes that we have recently added exposure to us, the capital goods segment we are really bullish about, and also we have included exposure to other real energy themes, so renewable energy themes. So these segments and themes, my colleague Vijay will discuss later in the slide. But there are few key risks also. While just to conclude this segment, and we feel that the unfavorable geopolitical situation, what's happening with China, or let's say Middle East, or for that matter Russia and Ukraine also, so that can play the some sort of spoil sport, and also inflation remains to be a key thing to be watchful out for, to be watch out for going forward. And any sort of negative development on the on the rate cut side can derail the journey a bit, right? So maybe it's just a matter of when the rate cut will happen, but any delay could again be a short-term setback for the market. So with that, I would conclude this section of the webinar and hand it over to you. Vijay, over to you. Thanks.
Yeah, thank you, Prabhat. Now we will move to the next section, which is based on the investment landscape. So basically in this section, we will try to understand or find out the industries which will be the leaders in the upcoming decade. So to find out those industries, we carried out the analysis on the developed economies. So to understand just this graph first, so what we have captured is the current GDP per capita mark of the India. So we are at $2,610 GDP per capita mark. And we compared it with the journey of the developed economies when they were at this juncture. So how they flourished, let's say which were the industries which get disproportionate benefit when they moved from $2,500 to, let's say, 3,000, 5,000, 6,500 and $8,000 eventually. So there are particular industries like real estate, credit, retail, mobility, electronics, mobility, or let's say recreational stuff, traveling, and all credit. So these are the different kind of industries which had like tailwinds when the GDP per capita went up. So if we have to summarize and consolidate these industries into the large buckets, so we come across those three buckets. The first one is the housing or the real estate theme. So because of the GDP per capita goes up, it directly translates into the higher personal disposable income. So your income goes up at an individual level. So people tend to purchase the houses in an accelerated manner, so which leads to the boom in the building material space like cement or paints or wires and cables or PVC pipes and etc. Second theme is the consumer discretionary. So once your necessities have been satisfied, so people will tend to spend behind the consumer discretionary items such as the branded apparel, electronic items, or travel or leisure space. So that again leads to a further demand for the consumer discretionary space. And third is the personal finance, or let's say the microfinance thing, because income has gone up. So people feel more comfortable with borrowing against their future income, which leads to the boost in the particularly on the MFI side. So these are the three themes which we have identified for the upcoming decades. In our opinion, these three themes will benefit disproportionately from this economic progression. And if we crystallize the numbers in the, if in the particularly related to the economy side, so please move ahead. Yeah. So currently we are somewhere around $3.1 billion, $3.1 trillion mark. If we look at the FY22 numbers, our GDP per capita is somewhere around 2.2, although it has moved to 2.6K now, the mark which we have recently captured. So this in let's say in the next 7 to 8 years, when we are looking at FY32, which is a from the current juncture around 8 years from FY24 end. So the our economy will stand somewhere around $8 trillion mark. Our GDP per capita will move to the $5,200 mark, and the total retail market, which is $781 billion of the retail side, which grow at 9% CAGR to $1.8 trillion mark. So our GDP, nominal GDP, is growing at 9.6% odd. Our consumption is also growing somewhere in line 9.2%, and retail market is also growing at a 9%. But the key thing that we should focus on is the consumption of the, let's say, the growth in the grocery retail and the non-grocery retail. So if we look at the grocery market, retail market is somewhere around $500 billion dollar, and it is expected to grow to 900 odd billion dollar at a 6.5% CAGR for next 7 8 years. Versus if we compare the non-grocery retail, which is a consumer discretionary space, so it will almost go up 3 times. It will move up from $280 billion to almost $900 billion at a 12.2% CAGR, which is the fastest among the all the consumption space that we have captured. So this is how the consumer discretionary will be the one of the winning sector. So apart from these three sectors which are benefiting from the economic progressions, there are also the two themes which we have identified which are getting the tailwinds from the government side. So first is the energy shift, which is the renewable energy theme. So government has set the mandate like the current capacity of the renewable energy is around 180 gigawatt, which will grow to almost 500 gigawatt by 2030. So this is also the space which will get disproportionate benefit because of the government push. And second is the capital goods or the infrastructure themes, which is the capex led by the government side. So the capex has been on the heavy lift, like the majorly, if we look at the last 3 4 years of the journey. So the capex has moved up from 7.5 lakh crore to 10 lakh crore, around 37% growth previous year. And this year also the growth has been around 11.1%, crossing 11 lakh crore of the market cap, 11 lakh crore of the total government capex from this side. And it has almost gone up by 3x in the last 4 years, if we compare the 4 year base line. So in our opinion, the capex from the government side keep increasing at 12 to 14% of growth rate for the next 7 8 years. So these are the two other themes which will be the auxiliary to the three themes that we have identified from the economic progression. So now we have these 5 themes as we have concluded with the our analysis, like these are the 5 industries which will benefit disproportionately. So now then naturally the question comes to mind, like so how we can identify the businesses from these industries which will help us to generate extraordinary or superior risk adjusted return. So for that we will move to, or we will revisit our the in-house built framework of the RH multi-bagger framework. Yeah, please move ahead. Yeah, next slide. Yeah. So basically, the multi-bagger framework, so some of you who have been our regular attendees, so they might be familiar, but for benefit of the larger audience, we will just quickly revisit it. So this framework we have developed in-house in the last 5 or 6 years that we have spent managing the funds of the public money. So this framework is based on the two legs. First is the growth leg, second is the value leg. So in the first leg, in the growth side, so we typically look for the businesses which will double its earning in the next 3 to 5 years of period. And with that, we will also look at the business which can generate, let's say, the grow at a speed faster than the industry average. So let's say industry is growing at 12 13%. So we'll look for the business which can grow at, say, let's say 15 16% of the industry growth rate, or 1.2 times of the industry growth rate. And once we have identified, we will carry out in-depth analysis. We will meet the management. We will try to uncover the modes, and we think it's a reasonable enough, then we will consider it further. The second thing is the valuation. So whenever we identify particular business, we also look for the valuation of that particular firm, and we look for the higher margin of safety. So we typically what we do is, let's say if we take example of the paint industry, so paint industry is somewhere around trading around 50x PE, and the leader is trading, let's say, at 60x PE. So we look for the business which is trading at a reasonable discount, let's say 25x PE or 30x PE, versus the industry as well. So in this case of particular paint industry, one of the business that we hold, it is at a 50% discount versus the industry. So if we combine these two legs, if the earnings go up by 2x and the valuation also move up from 25x to 50x in the 4 to 5 years of period, so the somewhere this stock will generate, or this business will generate at least 4x kind of return for us. And that is how we combine such 25 to 30 businesses with the same philosophy to diversify the some unsystematic or idiosyncratic risk. And even if we fail in our thesis by 25%, let's say 75% of the business don't go as per our plan, so still 75% of the business will end up generating decent return of around 3x or somewhere around that we target on the overall portfolio side. So that is the return part of it, like how do we capture the growth and the valuation side of stuff. But we also have the integral part of the risk management framework that we will discuss now. Yeah. So at RH, we strongly believe in the risk management side over the return management side. So we have basically three pillars of the risk management framework, which has also benefited us from and also prevented us of picking the subpar businesses. So first is the business risk. So we typically don't pick businesses which have unpredictable earnings, or let's say cyclical margins, or the moat is very narrow, or the moat is like eroding. Okay. Second is the valuation stuff. So as we have already highlighted, we don't like businesses which are trading at the above average industry multiple, or let's say the which has a low margin of safety. And third is the corporate governance. So we don't like management which is not investor friendly, or which is not open to the disclosure or the transparency side, and also not capital efficient. So typically we will meet the management once in a quarter of the various companies that we have on a portfolio. So we also keep the track record of their behavior in terms of accepting the mistakes, or how they can take the preventive measure that failures will not happen, and how they can quickly learn from the mistake and adapt it. So these are the stuff which we typically look on the corporate governance side. And if we find any of the, let's say, thing which is uncomfortable to the, let's say, from the corporate governance or the valuation businesses, so we typically tend to avoid this kind of businesses. So that is how the return and risk, we both part of the legs is combined, and we generate the superior risk adjusted return. Of course, this is the philosophy part of it. So we'll also discuss one case study to better help you understand that how we have actually put this framework in the practice. So this is the one of the business that we had entered somewhere around 3.5 years back, APL Apollo Tubes. So at that time, the valuation was around 33x P, and the growth was somewhere around, in terms of volume growth, plus 20% in the year-over-year basis. So we had decent compounding. The earnings went up sharply in the next 2.53 years. But what happened somewhere in the ending of the FY24, last 3 4 quarters, we started to notice that the volume has been stagnating. So if we look at the left side of the graph, so somewhere the volume was stagnating around 650,000 ton mark, which is a 6.5 lakh ton. And if you look at the last 5 quarters, so company has not been able to cross the 7 lakh ton mark, and it has been stagnating consistently. So somewhere in Q1 FY24, we took the decision. The valuation has already moved up from 33x to 55p, and the earnings had gone up almost 3 times during our holding period. So we decided to exit it, and we made it around 5x return in this business, and we shifted it to the emerging theme, which is growing at a very faster pace versus the structural tube leader APL Apollo Tubes. Just for the example sake, and this business has been growing their volume around 76% year-over-year, and quarter-on-quarter of 24% for the Q3 FY24. Of course, the names that we are using are just for educational purpose, so please carry out your own research and due diligence before taking any investment decision. So that is how we switched from the existing leader to an emerging leader, and also saved our hard-earned money of our investors from the erosion of the capital, let's say the valuation, or like the overvaluation side, or some kind of mishaps in the earnings side. So that is how the real case study, or the real business that we have actually done for the portfolio has been. Now we'll move to the next section, where we will discuss the 5 themes that we have highlighted. And so from these 5 themes, we have already picked multiple businesses. So we will just discuss the 5 businesses that we have picked from the five spaces like housing, consumer discretionary, finance, renewable energy, and the capex side. So first one is the steel pipes industry. So in India, steel pipes industry is somewhere around 10 million ton on the yearly side, yearly consumption side, and it is expected to grow at 12 to 13% CAGR in terms of the volume for the next decade. So one of the business that we have identified and still is in our portfolio is somewhere around 30xp, and it is expected to double its earning in the next 4 to 5 years. So we are expecting the valuation discount should narrow, which is 50% today. So the entry P will modify from 30 to let's say 50 or 60 after 4 years. So it will double from the multiple expansion, earnings will go up. So somewhere we can target 4.5 to 5x kind of return in the best case scenario. The second theme is the wires and cables. So again, the wires and cables, it's a more, it has been growing at 13 to 14% volume growth year over year basis for the last decade. And we continue to see that benefit idea basically from the housing demand side and the government's focus on the capex side. So these two legs should continue help the wires and cable industry to continue to post 13% kind of volume growth for the next 7 to 8 years. Third theme is the paint. So basically, this is a pure building material theme coming mainly from the housing side, where the consumption of, let's say, the accelerated purchase of the homes pick up in next to 7 to 8 years. So the paint industry, which has posted around 11-12% volume growth. So one of the business that we have picked in paint, so it is growing north of 20%. And it is expected to double its earning in the next 4 year period of time. So that is mainly from the paint side. The last two themes are basically from the finance and the renewable energy side. So before I we discuss on the NBFC, so I will just spend couple of minutes more on the renewable energy space. So in India, basically we are going under the energy transition. So we are moving from our dependence from the fossil fuel to non-fossil fuels, and with that aim in mind, government had set the mandate like we will be building capacities of around 500 gigawatt in the next 7 years by 2030. Current capacity is somewhere around 180 gigawatt. So the gap is 320 gigawatt. So we can assume the each year we will see the 45 gigawatt capacity addition from the government side. And the largest beneficiary or the largest segment in the renewable energy space which will get benefit is the solar. So today we have 73 gigawatt of solar energy capacity. It will go up to 280 gigawatt. So we will see the expansion of the solar energy by 30 gigawatt in a single year for the next 7 years straight away. So that is how the renewable energy space is a very significant, is benefiting from the significant push from the government side. And the business that we have identified is really is trading at almost 50% discount versus the industry, and it is also expected to double its earning. So that is how we have played the RE theme basically, and this particular business has gone up very sharply after we ended up taking stake in our portfolios. And the last theme is basically from the NBFC and the MFI space. So we expect this business to at least double earnings and also the price to book multiple to go up from 2x to 4x side. So that is how the five themes we have captured, and we discuss some of the ideas like how we are thinking in terms of the particular industries and how we are thinking from the particular management or the business side as well. So all these efforts have also led to the superior risk adjusted return for one of the our strategies, which is a super value. And just to keep things in perspective, so we started managing since scheme from November 2020, and since then the 1 crore of capital invested has almost become 2.9 crore till February end. And if we compare it with the index, which is as per the SEBI benchmarking, so the fund has almost outperform the index by 1 crore, or if we compare it with the CAGR performance, so it has almost outperformed by 16%, 38% CAGR versus the 22% CAGR. So that is also a outcome of our strong risk management framework, which is combining the risk and return both part of it. Before we conclude, so we have also extraordinary announcement because we are going through the general election phase. So we have also carried out some analysis on the election side that we thought we would just spend a couple of minutes before we conclude it. Yeah, please move to the next section, please. Yeah. So what we try to capture over here is like we studied the last 5 general elections, and we typically try to understand how the market has performed based on the policies which were formed once the election is concluded. So if we look at the first 6 months of period, so the euphoria is strong in the short term. So in the fast five data set, there is not even a single negative return in the 6 year period. If we average it for the 6 months, it's coming around 14%. The 1 year return is somewhere modest around 12%. But if we look at little bit of the long term, let's say 2 year perspective, when the government has won and most of the euphoria has ended, but lot of announcement is coming from the government side. They are trying to set the path for the next 5 years. And once this execution starts on those policies and the fruits of those policies start to play out, so we see in the 2 year period, there is not even a single negative return. Of course, we have to keep in mind like 2019, from the election, the 2 year period was impacted by the COVID. So 2021 was the negative year, but if we see the basically the 2022 financial year, basically the CY21 year has been a very healthy, but FY21 was negative mainly because of the COVID related falls and all. But later on, the things sharply improved somewhere around November 2020 or October 2020. We started seeing the fruits of the government efforts, and CY21 was the winner. So of course, that data set is impacted because of that 2.4%. But even with that impacted data set, the return is somewhere around 41%. So based on this data, in our humble opinion, we think like if anyone wants to, let's say, invest money in the stock market from the long-term perspective or increase the equity allocation or considering top up, so this can be the good starting point, or let's say the good reinvestment point, the phase that we are currently going in. And lastly, we strongly believe in the India growth story. And we think this is not a 1 year, 2 year, or 3 year, 4 year kind of trend. It's a multi-decadal wealth creation opportunity. And current time is a kind of a, let's say, Goldilocks zone for the person who is considering for the further investment or the fresh investment as well. So with this, we would like to conclude this session. Thank you, ladies and gentlemen, for listening us patiently on this Saturday morning. Yeah. Thank you, and over to you, bro. Yeah.
Yeah, thank you very much, sir. We'll now begin the question and answer session. So the first question is, like, what would be the focus areas for government post elections?
Yeah. So, if we have to discuss about the focus area, so what we have observed in the past also that there has been a continuation in the policy, be it like, Modi 1.0, Modi 2.0. So, whatever the investment is like, the policy decisions that were taken, like, in the first reign and like, second, and we expect the policies to continue, however, with a minor tweaking. So, of late, what we have seen that the government thrust is there on the infrastructure spending side, and there is a reason for that, like, every rupee spent on the infrastructure creates a multiplier effect of 2.2, 2.3. It means if we spend a 1 rupee creating an infrastructure, that will improve the GDP by 2 point, that will add 2.3 to the GDP, right? And there is also a continued thrust to revamp the railway ecosystem, right, which is there in the country. So there are like 500 Vande Bharat trains, one bullet train, and then there are 20 cities where metro work is going on currently. So the thing is that the railway plays a very important role in creating a huge multiplier. It has a multiplier of 4.1. So every rupee spent on the railways create a 4 rupees 4 to the GDP, right? So those thrust areas will be there, like the continued focus of the government on creating infrastructure, like spending on the railways will be there for the next term as well. Apart from it, there are new themes which are emerging, as Vijay has already discussed, that the focus will be there on the renewable energies, right? So we have to make the country sustainable, and then we have also taken a huge target of becoming net zero by, let's say, 2047. So if we have to go for the net zero and we have a peak deficit days going up every year, then renewable energies has a very important role to play. And we have the government has outlined a target of 200 gigawatt by 2030 or something. So that will create a lot of capacities in that segment. And I think this is again will be a key focus areas for the government going forward next year as well. Then government is also involved in creating a trade pact and free trade agreement with a lot of countries, like mainly from the European Union side, Australia, and then Africa as well. So those trade unions will make our export more competitive, make our manufacturing more competitive, right? So the thrust areas will be there, and we see that the manufacturing to get a benefit out of that. So those are 3, 4 areas apart from work being done on the AI side, space side. So, but then again, we don't have any practical idea to play at that point, that side of it. But like, whatever which is there on the land side, infra side, manufacturing through trade pact and all, and renewable energy. So we are already participating in those themes through our through the portfolio pick that we have currently. Yeah.
Thank you, sir. So the next question is, can we see a PSU rally to continue post-elections?
Yeah. So basically, I would just comment it like in terms of the PSU rally. So PSU had seen a decent rally, like a decent re-rating in last 1.5 years. So we have seen the multiple expanding almost 2 or 2.5 times. Let it be for some PSU banks, or let's say the PSC entities like the let's say the NTPC and all these things. So we think the multiple re-rating is more or less over for such businesses, or let's say the some banks which are owned by the government. But still, the growth rate which is there, which is at 12 to 15%, we have seen at industry level. Of course, the government entities have the lower growth rate because of their large size, let's say 11 to 12% versus the industry. So we think there will be some euphoria around the government thing side, but the long term thing is always valuation and the growth combination of both the factors. So growth and valuation, both factors are positive. Let's say one or 1 year, 1.5 year back. But right now, the only positive stuff is the earnings growth. So that will be the like the key driver of the returns going ahead. So there can be a rally in the government stocks as well, but that will be entirely led by the earnings growth, not by the multiple expansion further. Yeah.
Uh, Thank you, sir. So the next question is, will infra spending slow down after the elections?
Yeah, so no, like we don't feel that the infrastructure spending will slow down post-election. In fact, what we can say is that a lot of private companies, while we are engaging with them, we feel that they are sitting on the sidelines and waiting for the election to get over. So till now, we have seen government spending supporting the market and supporting the economy in a big way. But going forward, also since I've already shown, like how a lot of companies are sitting on free cash flow, they have ample room to take leverage also to expand the capacity, right? And we have seen in past a lot of companies raising cash through QIP as well, right? So those tech companies are getting ready to expand the capacity, and if you look at the capacity utilization also at an economy level, currently we are at around 76, 77%, right? And this is a peak capacity utilization that we are running. It can go up to 80%, but after that, companies have to increase new capacities. So both on the private and public side, we'll see the infra spending to come back and support the markets. On the recently held budget, government has outlined 11 lakh crore infrastructure spending for the year. And if you compare that to last year, that's a 10% jump. But we also have to take note of the fact that the entire spending will be done in 9 month period rather than 12 month period. So if we compare on a pro rata basis, it's a decent jump from the last year also. And if government has outlined to create some bit of infrastructure on the railway side, and then also pushing for renewable energy infrastructure to be built, so all those things will keep on continuing for the entire term that we see, at least for the next 4 or 5 years. So we don't see that the spending to slow down in the near term.
Yeah, thank you, sir. So the next question is, how are we positioning the portfolio for next 5 years?
Yeah, so as we have already outlined in the PPT, and we will just quickly revisit the five themes that we have discussed. One is from the building material side, second is the consumer discretionary phase, third is the finance. The two themes which are coming especially from the government stage, one is the capex, and the last one is the renewable energy side. So these are the five themes, and we have already highlighted some of the businesses that why we like or why do we prefer, let it be from the steel pipe space or wires and cables or the paint segment or the renewable energy space and the capex side. Also on the renewable energy side, we don't think like government will stop spending because we have to create 45 gigawatt capacity every year for next 7 years. And if we particularly in the RE space as well, 30 gigawatt will be built for solar energy, moving from 73 gigawatt of solar capacity to almost 280 gigawatt. And overall level, the capacity of the RE will move from 180 to 500 gigawatt. So the 45 gigawatt in total for the next 7 years. So these are the themes which are already outlined for the next 7 years. And once you start to spend, you have to build the projects. You have to, let's say, power plants. You those power plants will be, let's say, reaching their capacity utilization, peak capacity utilization, maybe next 4, 5, 6 years, 7 years. So the power demand is also growing up, and the shift which is coming from the fossil to non-fossil is accelerating in a huge manner. So we think these are the five themes which are benefiting extraordinarily. So that is how we have positioned our portfolios. Of course, there will be some correction or there will be some problems with particular businesses, but we are fairly diversified in terms of 25 to 30 businesses coming from various segment side. So we'll keep taking out some of the laggards, or let's say the thesis which is not playing as per our plan, and we will keep uh, picking new businesses from mainly from these five themes. So these are the five themes that we are betting, and our portfolio is positioned across these five themes largely, maybe 70 to 80%. 20% of the themes are like let's say pharma or the IT, which are the bellwether of the, let's say, the cash cow for the overall year, because they have been the consistent growth kind of a place. Yeah. So that is how the portfolio is positioned for us as of now for the next 4 to 5 year perspective. Yeah.
Yeah, thank you, sir. So the next question is, like, if we are to invest, is this a right time or wait for elections to get over? And how are we allocating staggered or a lump sum manner?
Yeah, so for fresh investments, we recommend that correct, right now is the right time to go about making investments. And whatever the fresh money that's coming our way, we are staggering it till elections, right? So there is a 2 months to go till election. We are making the deployment phases so that it gets deployed fully before election. And also, whatever the positives that we have just highlighted, and in fact, there is a good election effect, right? There is an anomaly in the market that after every election there is a rally if the results are in favor. So clearly we see that some bit of value to be built in, right? And that will be coming our way. We have seen a teaser in the last, the state elections as well, which has happened in the month of December. And we have seen the markets to rally. But after that also, for now also, we see the same sort of rally to be built in. And in fact, for the long term also, right? We see that since there will be a policy continuation and a lot of people are sitting on the sideline these investors will also come back and participate in the market. So we expect the market to move. And if somebody is sitting on the sidelines, so now is a good time to again start making the investments.
Thank you, sir. The last question, like, what's the asset allocation recommended from this point between equity and debt, and within equity across large, mid, and small cap?
Yeah, so on the equity allocation side, it's a very a personalized approach to it, right? But if somebody is coming with a moderate risk appetite, I think 60, we are recommending 60-40, 16 to the equity and 14 to the debt side. And between debt and equity, in the within the equity also. So currently what we are doing for aggressive investors who is investing into equity, 75% of the allocation is going to the mid and small cap side. 50%, 45-50% on the mid caps, then 25-30% to the small caps, and then remaining 25% to the large caps, right? If an investor has a moderate risk profile, so maybe it could be 60-40, 60 to the mid and small cap side, 40 to the large cap side, considering that investor is coming with a time horizon of at least 4 to 5 years into the market. So clearly, if you're coming with a time horizon of less than 1 year, so no, don't invest into the mid and small caps. It could be a volatile phase for you. But if you have a longer time horizon, then I think 60-40 allocation should works wonderful.